Good morning. I want to cover IGLD today, and as usual we'll start by technical analysis. This is the long-term chart going back to 1999 when the company had its IPO at around $12 or so. It is now at 17, so just above what it was almost 8 years ago. But now we have the stock is bullish, as you can see here on this right part of the chart. Let's check the medium-term chart. Okay, it is above the 50 days and the 200 days moving average, so trending up. Over the short term, well, we just crossed this 15.6 resistance level with a very high volume, and the stock keeps trending up here over the short term too. I wish I had seen it here this low, but we'll have to study fundamental analysis to get a better picture of the future. I don't go just with the charts, you know. Okay, so let's make a brief fundamental analysis on IGLD. This is the share count and market cap over the years since 97. Here the company wasn't publicly traded yet, so it had just 13.9 million, at least not in the US exchanges. And in 1999 it had 18.4 million shares outstanding, and currently 19.7 million. The share count has remained the same over the past 8 years or so, but now it is starting to rise because the company made a big acquisition lately, and there are a lot of convertible debentures and stuff like that. The market cap since 1999 has been declining 3.5% a year, since it was 443 million in 1999, but that was due to the speculative bubble, you know. As you can see, it was just 31 million in the December 2000. So okay, let's move on. Here we have the balance sheet study and with the current ratio and long-term debt. Long-term debt here rose a lot to $131 million, also because of that acquisition, and the current ratio is dangerously low here at 0.6. I like to see it above 2, so the short-term liquidity picture isn't nice, with cash and marketable securities accounting for 19.5% of total current assets, but current assets are lower than current liabilities, and I don't like this situation. Moving on to the revenues picture and the gross margin. Well, this chart tells me revenues are growing nicely, and they'll probably have a big jump here in 2007. Not probably, almost for sure, because of that big acquisition. But the gross margin that is operating profit as a percentage of sales, or gross margin, has been declining as revenue grows. Also, I don't like this picture. I like stable and high gross margins and not declining. Revenues are growing since 2002, 25.9% on average, until 2006. I didn't consider 07 here because these are not comparable situations. And the gross margin now is 31% for our company and 47% for the industry average. And the price to sales ratio considering 2007, but I'm afraid the share count will grow a lot in 2007. And that will make this price to sales ratio rise to the more close to the industry average of 2.9. As for earnings per share and net margin, well, the company has been profitable since 2002, but there wasn't much growth here between 2002 when it made 23 cents of profit per share to 2005 when they had 22 cents, so it even declined 1 cent in 4 years. In 2006 things went much better, and they delivered 34 cents of earnings per share. For 07, analysts are expecting $1.04, but the company just missed estimates by 1 penny. on the earnings side. On the revenue side, it beat estimates, so I want to see how the market reacts to all this. But they made 23 cents on a I believe fully diluted. Let me check that in a minute. No, they made 19 cents on a fully diluted basis, and on a basic they made 23 cents, and analysts were expecting 24 cents. Anyway, net profit margin here in the first quarter of 2007 was 6.15%, and the price to earnings ratio, considering this 2007 estimate, is just 16.3, and the industry average is 41.9. But I'm not sure IGLD still is just let me check here, sorry, an internet service provider. It is also a telecom business too, which it trades at a much lower earnings multiple. So let's check my valuation model. Here on the, I need to estimate these 4 white lines. The yellow lines are known facts, and these dark yellow lines are calculated by the model. So let's just focus on these white lines. Dilution factor, I put here 10% due to those outstanding debentures convertible, so I expect 10% average dilution going forward. Also, the balance sheet is very, very weak, so 10%. Revenue compound annual growth rate, I put here 17% for the next 3 years, because the company they bought is growing 12% a year, and they were growing about 25% a year, so I put it here in the middle, more or less in the middle. But I don't like this situation of buying a larger business but with less growth and less profit margins. As for the final net profit margin estimate, I put here 7%, because I expect the merger results to improve net profit margin, but not by much, and I can't give it an earnings per share multiple estimate higher than 20, because a telecom business usually doesn't have a very high earnings multiple, so 20. Still, the stock is, I expect the stock to rise 14.7% a year going forward with this data and estimates, which can change a lot with quarterly results, but this is what I have now. And this gives me an optimal selling price of 16.44, because which is below what the share price closed yesterday, because I like to see this share price compound annual growth rate expected above 16%. So below 16% I don't consider the stock attractive. And on a 1 to 10 scale, this wasn't meant to be an 8 but a 7. Okay, thank you, bye.